All right, so today I want to get into using some of the tools that we all have access to on the broker dealer side of things. And for some of you guys, you're using these tools like eMoney, Wealthscape, FMAX. For some of you guys, you're brand new and just kind of getting going. So I would say grab what you can, take some notes, and maybe a big takeaway that we'll hit at the end is the technology that we have at our fingertips is only valuable to the extent that A, we use it, B, we put some energy into understanding it, and C, we kind of I'll call build it out, and I'll explain what that means in a moment. So I want to tell a story of a case I picked up last night, and the numbers don't matter; they're pretty large, but the whether it's as a $50,000 rollover or $1 million rollover, it's the same mechanics, and I want to talk to you guys about kind of this will encapsulate everything that we're doing on FMAX. Okay, and so as a byproduct, in fact, I'm going to start. I'm thinking about the order I want to do this. So let me share my screen here, and let me get into my FMAX dashboard. All right, so this is my FMAX dashboard. Hopefully, you guys are all seeing that. And so one thing we've done a lot of training on is our models that we have or that I'm using, and you guys are welcome to use. I think most of you guys are using them. But I'm going to come down here and just show you um, kind of what I'm doing for my clients, why I'm doing it, and what I believe. So I'm going to focus on my aggressive model for right now. In fact, actually, I'll do moderate aggressives, and that's probably a little bit more used. So, guys, what I'm doing in my model, and I want to talk about what's happening in our economy right now and how you can use hopefully some very specific talking points from today, put them into use. And by the way, when I say something like a key phrase, a key talking point, the best advice I'd have for you would be A, write it down, B, review this recording, but put it into practice right away. And once you start using it, I just can't tell you how that helped me early in my career. Leaders would tell me like certain phrases, certain key questions to ask. And if I put them in context and put them in practice right away with real people, that somehow like solidified it for me. If it was just notes that got folded away in a notebook and tucked back in a drawer or left on the corner of my desk, then it just wouldn't help my business at all. And one thing I can tell you guys is I've been doing this for 26 years, and I've never seen what I'm seeing today. I've never seen a combination of an economy being so robust, yet at the same time, job dissatisfaction and worry about job security with tech changes and AI and economic shifts and all kinds of things. It's never been an all-time high. In other words, usually when the economy is doing well and the market's doing well, there's not a lot of people we can recruit because everybody's doing well, making money, getting bonuses, all that kind of overtime, all that stuff. Usually when the economy is doing bad, maybe your production is slowing down or accounts are down, but more people are recruitable. We're in an environment right now where all cylinders are firing, and I think, and I've been telling this to people, I think we are in the bull market of my lifetime, and I think this will run for years to come. It doesn't mean it's going to be a straight line to the top. In fact, most healthy bull markets have meaningful corrections. And the thing is we've had them. I mean, we've had three bear markets in the last 6 years and a couple other corrections, and it's shaken a lot of people out. And so I don't want to make this a big talk about the market today, but I just want to tell you guys, you can live on the rest of what you do the next 2, 3 years here could set you up for literally the rest of your life, in terms of assets you gather, teammates you onboard, markets you get into. I've told you guys in the past, this is a race for assets. It's a race for outlets. So assets are clients that we can serve and get under our management. Outlets are teammates we can onboard and have them learning the system and building out your infrastructure. But I want to look at this model right here. And guys, I've done a couple things on purpose that have helped me tremendously in my business over the last 6 to 12 months. So number one, I've built 5 core models that I put almost all of my clients into. There's some exceptions, which we could talk about in other trainings, but there's a couple things to my models. And I've prioritized simplicity. I prioritized low fee minimums. In other words, if I started blending in, some different mutual funds, some different SMAs or those kind of things, all of a sudden you have to have $100,000 for your client to use the model. And so to me, that's counterproductive. So by me using what you see on the right here, by me using this Fidelity target allocation and then the S&P 500 and the large cap index, it's allowing me to keep the minimum very low. So I think the actual minimum's like 16,666 or something weird like that. But I routinely have clients that are at least 7,500, which is kind of a hard deck. We can't go below 7,500, but as long as I have $7,500 in an account, we can get it traded into this model. So I've got clients with $10,000 accounts, and I've got clients with multi-million dollar accounts in the exact same model. In number two, what I'm doing, and this is going to really tie into my training today, is you guys don't have to be market experts. You don't have to go get a CFP. You don't have to do any of that to have, a lot of success here. But you do have to have a basic understanding of what's happening in the market and why it's happening. And you've got to have a couple key phrases you can repeat to people that are going to help them click. And I would tell you that the business we are in is taking something that seems complicated, seems overwhelming, seems like hard to get your arms around, and make it really palatable and digestible where people can understand it. So one of the things I'm doing is I tell clients, here's a couple talking points that you've heard me say, but it's worth repeating. I say, I've generally done, two key things the last 15 years for my clients. And if you guys are first year, second year, third year in the business, you could just modify that. Say, hey, as a team, there are two primary things we're doing for clients in terms of their portfolios that we're managing right now. So you change the wording just a bit. But number one, we're of course we're building globally diversified portfolios, and we're using the best resources, the best managers, the best funds that exist in the world on our platform. But we are overweighting the US over international. And so I'll point to my model right here. And so, for instance, if I pull up just this 70-30 allocation, so you guys know that's 70% stocks, 30% bonds. Okay. But of this weighting, so of the 70% stocks, 21% of the 70 is international. Okay. So what's that weighting right there? Well, if I divide 21 divided by 70, so that's 30% international. So you guys following that? Now, my personal opinion is that that's more than I want international. The U.S. market's been the market to be in the last 14 out of the last 15 years. Last year was the first time international outperformed it. It's kind of even money so far this year. But you guys, I never have clients disagree with the following statement. The U.S. is the epicenter of the world's economy. We're the reserve currency of the world. We're the global superpower of the world. Obviously, China's, rising there and probably on the same level in some effects. But economically, we are the engine of the world's economy. And so I want to be primarily focused in the US. All of the tech growth, all of the AI, all of that is coming out of the US and gets me to phase two, which is I not only want to overweight US, I want to overweight growth. So I don't necessarily go into quite this much detail, but I would. So if I showed you the Fidelity target 100 to 0 model, you would see the same thing. It would be they would just get rid of the bonds, and you'd have 30% international stocks, and you'd have 70% U.S. stocks. So what I want to do is if I go back to my model here, by blending in the S&P 500 index, and then what I'm doing is I'm getting more pure U.S. stocks. And number two, by blending in the large cap growth index, I'm further tilting the portfolio towards growth. Now, this is going to make a lot of sense to you in a moment, but basically some market, knowledge for you guys is every single stock, every single mutual fund that exists is going to be categorized in one of these asset allocation kind of areas, right? So it's either going to be called a growth fund or a growth stock, or it's going to be called a value fund or stock. or it's going to be called a mid cap, or small cap's not listed on here, but it's a small cap. You guys get the drift there? So this is just a broad brush way of tracking, okay, what kind of stock is this? What kind of fund is this? Well, when you see core, that's basically a blend of both. So this would be mutual funds that are part of this. So if I go back to this model again and go back to composition, some of these models, right, are if I were to look up the tickers individually, you would probably see them. There's a blend of value and growth. So real quick, just so we're on the same page, what is value? What is growth? Well, a value stock tends to be a stock that is more of a mature business, tends to pay a dividend. So I'll use an example like McDonald's or Walmart. These are value stocks. These are very mature businesses. They're not really opening a lot of new McDonald's around the country. It's pretty saturated. So the end game for McDonald's is how can we drive traffic, get same store sales up. If McDonald's can grow 3, 4, 5% in a year and pay a dividend, that's a great stock. But it's also going to be more consistent, right? People are going to go to McDonald's in a good economy and a bad economy. So their stock isn't going to appreciate as much, but it's just going to be more of a steady performer. So that's a good example of a value stock. A growth stock would be like NVIDIA. It's basically NVIDIA pays a dividend, but it's tiny. Nobody buys it for the dividend. But NVIDIA is basically taking all of their profits and pouring it right back into expansion, invention, and really, pioneering new technology. And so when people buy NVIDIA stock, they're buying it for the growth that they're going to see of that company. So historically, growth stocks are more volatile than value stocks. But I would tell you that we live in an economy right now where AI is the tip of the spear, but like all of the things downstream, right? It's affecting energy, it's affecting infrastructure. Caterpillar stock is going crazy because all the data center build out. So you can like follow all of these things downstream. So growth is where you want to be. Growth is capturing a disproportionate largest percentage of all the return out there. In fact, if you look at the S&P 500, the S&P 500 is becoming more of a growth index because the biggest companies in it are growth companies. So the growth companies are growing bigger and bigger and bigger, which means they're crowding, they're taking up more space, and there's less and less room for the value companies. So that's kind of what's happening under the hood. So let me just pause right there. You guys, any questions on that, or is that kind of making sense to you guys? So one thing I want to ask you guys a question here. I've said forever, for those of you that have been around for a while. So there's two things you have to have in order to get client business done. Two absolute non-negotiable characteristics, we'll call them, that are non-negotiable, that they both have to be present for somebody to trust you with any kind of business. Anybody want to venture a guess on what those things are?
Trust and credibility.
Good answer. All right. Why are those non-negotiable? Well, I could have all the credibility in the world as like some sort of guru. Maybe I do a bunch of marketing. Maybe my face is on a billboard somewhere. Who knows, right? But if somebody doesn't actually know who I am, have any kind of relationship with me, they're more than likely not going to say, hey, you know what, this guy looks legit. I'm just going to like have him handle my 401k, right? You guys get the drift there, right? So credibility is, or I'm sorry, trust is critical. And credibility is critical because likewise, and I'll take Logan as an example, not Shane Logan, but Logan Hagemeyer, brand new with us. So Logan has a network of people he knows, and all the people that Logan knows, I think consider him to be like a good guy and on the ball, and he's sharp for his age and all that kind of stuff. But he is also, I don't know how old you are exactly, Logan. Are you 21 yet or 20?
I'm 20.
All right. So you're 20 years old. Hey Logan, so I can see this. If Logan was trying to like go out there and prospect on his own, let's just assume you're fully licensed for a moment. And it's gonna be like, hey Logan, man, I really think you're on the right track. I wish you the best. I'm not sure I'm going to hand you my life savings to invest because you've been doing this for 10 minutes, right? There's no credibility. You guys get the drift? So in our process, our field training is so valuable because when Logan brings Alec into the field, he can introduce Alec. He can take the trust that he's got, transfer that to Logan, and basically say, hey, I know you and I have known each other for a while. This is my business mentor, Alec. He's been doing this for 10 years, and all the things he'll say about Alec. So it's that passing the baton of trust, and then Logan, or I'm sorry, and then Alec, having been properly set up and introduced in a beautiful office, and then has the presence to communicate very clearly, is going to demonstrate credibility. And so that's where we can fast track trust and credibility. And then once you get established in this business, for my network, when somebody gives me a referral, I have trust and credibility, by nature of that. So what I brought that up to make a very important point. So I met with a client last night. He's been a client of mine for over 15 years, maybe a bit longer than that. And for the entirety of our relationship, I've had money that I've managed for him, an IRA rollover from a job he left forever ago. But he's also had a relationship with an advisor at Edward Jones. And kind of the story of our relationship the last 15 years is he's always kind of benchmarking us to each other. And he's kind of, and so for 15 years, it's been kind of a friendly Cold War. Like, I'm always trying to get him to move his Edward Jones account over to me. Edward Jones is always trying to get him to move their accounts over to him. And then along the way, my client, his name is Rob, which you'll see in a moment, is like, I just want to kind of like open up an E-Trade account and buy some of my own funds to see if I can do better. He's just kind of like, it's just kind of his nature. He's a great guy, but he's just kind of like, I just want to see like which is the faster racehorse. And if I can do better than both of these guys, maybe that's just what I want to do long term. That's kind of been the backdrop. So essentially, he's got an Edward Jones account that's grown sizably. He's got accounts with me that I've grown quite a bit. And he's got this E-Trade account that he's put some money into and try to do some things. So what's present in this relationship is trust, because we've literally worked together for 15 years, and he's generally been pleased with what I've done. Credibility is also there, but there's also trust and credibility in these other sources. So long story short, he was in for a meeting a couple months ago, and he's getting ready to retire in the next 2, maybe 3 years. And he's like, Tyson, Pam and I have been talking, and we think that it's time for us to we just got too much stuff all over the place. We really want to consolidate to one advisor. And frankly, we don't know if it's going to be you or if it's going to be Edward Jones, but we feel like we need, and by the way, in that meeting, he says, and I got this guy from Savage that's like all over me. So that I now got another guy coming out of left field, right? That keeps telling me how much, they have resources wise, and we've got experts in the office and all this stuff, a whole big marketing spiel. And so I'm like, okay, like it's now or never. So I started working on, hey, I want to demonstrate to you what I've done and show you a path forward. And so that led to basically another meeting a couple months ago where we made some progress. And then on a phone call a couple weeks ago, he kind of gave me an inclination that his wife really feels comfortable with me. He has been comfortable with me. And he's basically like, I think we're ready to move forward. He's just a little wishy-washy. So that sets up last night. So I'm getting ready yesterday for a meeting. And I wanted to, kind of be prepared for a couple things. And I just know I've been down the road with this guy enough that even though trust is there, even though credibility is there, even though he's told me, hey, I think I'm ready to consolidate everything to you, I'm like, we don't have the ball over the goal line yet. So this is what I want to get into a couple of things with you guys. So I went through all of my models to hopefully set the stage for using some of our tools. So along the way, a number of years ago, I got this guy set up with eMoney. So I'm going to pull him up in eMoney and show you what I did and how I used eMoney. So eMoney's been a valuable asset just to give him. So this is my dashboard of eMoney. So he's got, so a couple months ago, I moved his accounts from Goldman Sachs to Wealthscape, or FMAX, but Wealthscape, is kind of what we label things. So but I've linked, so some of these aren't like nicknamed, but this 847,000, that's his Edward Jones, one of the accounts. This 100,000 is his 401k, which we kind of figured that out last night. It's a bit of a mess. So he's got some other things in here. So what I started to do with eMoney that I haven't done until recently is I used to kind of show clients this view, which is our view, but it's not the view that they see. And so I just figure it's a little bit easier if I work with their view. So if you click this globe button over here and go to View Client Portal, you're going to pull up what they see. And so this is what I've been using. So I was getting ready for the meeting last night, and so he had emailed me statements. And when he emailed me statement, I don't have that pulled up, but basically, Edward Jones shows, how much your account has grown in the last 1 year, the last 3 years, last 5 years. They just put it right on the statement. And the statement was through the end of May. So this is like real-time data. So this is through last Friday. And essentially, his account at Edward Jones over the last 12 months had only grown about 10%, which is better than nothing. But in this market, I'm like, that doesn't seem very good. And the 3-year return wasn't that great. The 5-year return wasn't that great. But in this guy's so rate of return driven, I'm like, well, why did it only grow 10%? Well, if I come in here and I go to investments, and then I'm going to pull up his actual account here. Here we go. All right. So if you come down, this is all of his holdings. So by just looking at the holdings, and by the way, I could see the same thing on a statement, what I'm recognizing is there's a bunch of individual stocks in here. Now they're charging an advisory fee. It's basically the same fee I would charge, which is on this account size, it's about 1%. And what's happening is this is what's called an SMA, or a separately managed account. And we have a ton of these on our platform, which is basically like a private mutual fund. And so I'm like, okay, but it's hard to know. I mean, I'm not going to pull up every stock and see what stock has done what and all of that. But I was playing around eMoney and I stumbled on something I've never seen before, which I go on this allocation right here. Now, you tell me what jumps out to you guys when you look at this. Let me change this. Here we go. So this is that actual account. So what jumps out to you guys when you look at these categories here and you look at this allocation?
I
A
can't
lot more value.
Yeah, a lot more
Sorry.
value. Okay. What else, David?
well, sorry, I can't see. I'm trying to zoom in. I can't really, hang on. Oh, there we go. Okay. There we go.
So I'm specifically looking at like, now this isn't like an order here, but the largest holding is large cap value.
Hmm.
So for context, this guy has always been like pedal to the metal, all stocks, growth. He's unfazed by volatility. He's on my short list of clients that are completely unfazed by 20, 30% drops. So we've been aggressive all this time. So in other words, this advisor, Edward Jones, has them way heavy in value. And then blend is again a mix of value and growth. Look at this large cap growth, only 3.6%. So I show Rob, I'm like, Rob, like this isn't doing so well, man. Like, and I'm never gonna overemphasize recent performance, but I do emphasize why is what's happening. So I'm like, this just doesn't align with what which by the way, I should say before I get into all this, I'm like, are we ready to kind of get everything consolidated? He's like, yeah, I think I am, but I don't know. Maybe I just want to leave some with Edward Jones. He's just very wishy-washy.
Mm.
So I'm like, well, let me give you some data to maybe help you feel better about what I think you should do. And that set up what we're getting into here. So I show him this. So then the other thing I showed him is I pulled up Awbridge, which most of you guys should have access to. So now this is updated 1 day later, but as of yesterday, this was through the exact same day, and I could go and play with it, but it's essentially the same number. So his accounts with me in the last 12 months are up 26% net of fees. So Edward Jones, he's up 10%. With me, he's up 26. And I'm like, Rob, this isn't because I'm a genius. This is because I just have you allocated properly to what you've told me is important to you. And frankly, to where the market is at right now and likely continuing to be. And so that was a big like light bulb. Like, wait a minute, I guess maybe Edward Jones isn't paying attention to my account like I thought they were. Okay, so you guys get that drift. And so that pretty much was the nail in the coffin for Edward Jones. And by the way, I went and we looked at the 3-year return. I have it right here. So Edward Jones in the last 3 years is up 35% cumulatively. If I click 3-year trailing here, now this isn't a cumulative number. I guess I could do that math, but he's up 19% annualized, which is way more. I mean, that's like a 55%, or 60% cumulative return. And so and we went to the 5-year return was even more. Essentially, I'm just like killing this Edward Jones advisor. And I think candidly, she had a couple of years where she was better than me, but luckily those haven't been the last 3 to 5 years. So I want to pause right here because I'm going to take this one step further in a moment. But do you guys see where using the data I have in Allbridge, which by the way, and I could have shown the same thing in FMAX, but because his accounts were at Goldman and only been at Wellscape for a couple months, this was kind of the way to show them. But in the future, FMAX would even be a cleaner way of showing all of this. But showing them what I've actually done, helping them understand why have your accounts done better with me and why are your accounts not doing well at Edward Jones. Can you guys kind of see how those tools, in other words, there was nothing I was going to say last night without data that was going to get him all the way over the goal line. I promise you. 15 years in, I'm pretty good at this, and I wasn't good enough to be like, can you just finally move your account to me? Just trust me, I'm going to do a better job. I had to have the data to verify. You guys get that drift?
Mhm.
All right. So that was like 950 grand we moved over. And then, and by the way, we're going to ACAT that. It's going to be 3 days. Boom. We're just going to get those assets over. But then I mentioned to you guys, he has this E-Trade account. Let's see if I can find that here. Let me go back. See which one that is. He just calls that rollover IRA. So he loves this E-Trade account. He likes picking some of his own stocks. Here we go. So these are some of his own stocks he's picked, but he admits he doesn't track them very closely. But he's told me about oh, wait a minute. I'm not on the right account here. Sorry, guys. I'm a little bumpy with this. Here we go. So these are some of the stocks he's bought. You can see he just bought 10 shares of this, 40 shares of that. They're all even kind of numbers. Here's just stocks that he reads about that he tracks. But he's been talking to me forever about this Oak Mark Investor Fund. And he just thinks this is the best fund ever. And this is a long-term, Oak Mark's a really quality company, great long-term track record. And so we had already done Edward Jones. He's like, all right, I'm paraphrasing, but I'm sold on that. We're going to move it and all that. The wife feels good about it. And we talked through that whole thing. But I'm like, you know what? I'm going to take a swing at E-Trade too. Because I didn't think going into last night he was going to move some of this. And he's like, yeah, but I'll definitely want to keep E-Trade because, I mean, that Oak Mark fund it's been so awesome and all that. I'm like, are you open to a different opinion on that? And he looks at me kind of inquisitively. And I said, well, let me just show you. You might be surprised by what's happening in that fund. So look at that ticker symbol, Oak MX. So I just go over to here. And there's a bunch of charts you can pull up, but I just pulled up Morningstar's. So at first glance, 4-star fund, pretty solid. Now look at this expense ratio. It's not inexpensive for a no load fund. It's 89 basis points. Got a pretty decent amount of turnover. So he's probably paying over 1% out the door on this fund in terms of trading costs and all that. But if I come over here to performance, check this out. So I've come over here, year to date, this fund has lost money. That's not great. Last year only made 14%. Morningstar is going to tell you the percentile. So all actively managed funds are going to have periods of overperforming and underperforming. That will always be true. That's not debatable. So look at this percentile rank. This was the number 4 percentile, meaning top 4% of all funds in 2021. And then all of a sudden the next year it's the bottom 6%. 2023, it's the top 1% of funds in the universe of funds that it compares to. Can you guys see the volatility of performance here? Okay. Now we're back to 99. I mean, this thing is like, not doing well here. Is it because Oakmark doesn't know how to manage money? It's not. It's because this has a bunch of value stocks in it. If you go and you look at holdings here, let me go to the quote. It'll tell me top 10 holdings. Do you guys see any growth stocks in here? Look at the categories: energy, financial, healthcare, materials. This is value, cyclical, defensive oriented stuff. More consistent stocks, but not going to grow. I mean, none of this stuff is like tech, AI. I mean, they got Salesforce in here, which is an abomination. So essentially, you don't have a lot going on here. And then I showed the last 1 year return. If you come down, let me go back here to performance. And so now it has rolling time periods. So rolling 12%. Rolling 3 year, okay, it's had a bad year. 3 year, it's made you 16% a year. And I'm like, Rob, don't listen to what I'm going to do for you. Listen to what I've already done for you. The last 12 months, instead of being up 12, you're up 26. So at this point, he starts laughing. He goes, well, at least I beat Edward Jones. So I'm like, okay, so I've had a good year, but what about the last 3 years? So we go look at the last 3 years. Oakmark's done 16%. And by the way, you're paying Oakmark the same money you're paying me. That's an expensive fund, right? And you're on your own. Like, I'm literally costing you no more money, and I've made you 19% after fees. And it was at this point where he was like just on the verge of being toppled over. And his wife looks across the table and goes, Rob, what are you doing? Just let Tyson manage this money. Come on. So we settled on like most of the account. He wants to keep his NVIDIA. And there was one other thing he wanted to keep. I can't remember what it is now. But it's like, so he's going to leave like 50 grand in the account to play with and then move the other three. So again, the numbers are over $1 million. Whether this is $1 million, 100 grand, 20 grand. I wanted just to show you guys where, like, putting some energy into knowing what you're doing and why you're doing it is really valuable, okay? Because you don't have to watch CNBC all day. You don't have to track every single day what's happening. I went to my tennis league a couple weeks ago, and one of my teammate guys, he's a huge realtor in town. He goes, he's like, Dow crossed 50,000 today, and I'm like, dude, I don't know. I was in meetings all day. I didn't pay attention. He's like, oh, you're supposed to know that. I'm like, that's not what I do. And we kind of laugh. But it's like, you guys, you don't have to follow the market every single day, okay? But you do have to understand some big themes. And I'm telling you, tech, AI, infrastructure, all things U.S. growth. Guys, this is going to be a dominant theme in the market for years to come, with volatility, with hiccups, but that's the horse you want to ride. The models we build are really allocated towards that. But you guys, if I hadn't gone and done the work of serving this client, getting back, and adding his accounts to eMoney, demonstrating that value, that gave me the data, right, that I otherwise wouldn't have had. And by the way, it just helped bring this all together. And so you guys, we have world-class tools at our disposal, but they're only world-class to the extent you use them. And so a quick wrap up, and I want to open this up for some thoughts or questions, is number one, everybody in our company has access to eMoney, but the vast majority of reps aren't using it. They don't have clients using it. They haven't encouraged clients to, add their other accounts and all that. And candidly, I can get better. I've done all my bigger accounts, but as I'm doing all my, transfers to FMAX and all that, I'm making sure that eMoney is part of that process. Most people haven't really gotten in and tried to understand FMAX. They're still using FMAX like they used Goldman Sachs. They're picking a couple funds. They're not using models at all, which I think is insane, but they're just literally like building account by account, just like we used to with Goldman Sachs. I'm telling you, that's where the whole company's at. And so we have these tools, you guys. So I want to encourage you guys to use these tools and get deep into them. And the more you're in, setting stuff up, playing with it, calling field services, calling Alec or me or whatever it is, and just learning things and then putting those to use in client meeting, client updates. You guys, this is a season right now to be picking up new assets. This is also a season to maybe advance client reviews. If you did a client review 6, 8 months ago and you're not due for another one in a few months, I do it now. And I show the client how much their accounts are up and make that positive emotional deposit to their bank account, their emotional bank account of like, look how much we're up. And most of you guys should have access to this Awbridge, but like one thing I've always liked about Awbridge, which shows things because this is going to pull in. Now this client doesn't have annuities with me or anything, but it'll pull all that together. But it's going to show like actual value. Like in the last 3 years, I've actually made this guy $289,284. Like that's a big number. And sometimes percentages kind of get wonky and they don't really land the same. But like you show somebody, hey, we're up $52,000 since we've last met, or we're up $21,000, right? A $21,000 gain to some clients is life changing. To other clients, it's a rounding error, right? But all of these things are positive things that you can reinforce. And so if you want to amplify referrals, you want to increase how locked in your clients are to you in terms of this business. I just think now is a time to be looking at your book and looking at prospects and using some of these phrases to really communicate, because a lot of people hear these things, they just don't know, how do I start? Is it too late to buy Nvidia? Is it too late? Wow, the market's already up this much. I can't invest now. And of course we could talk about all those things, but guys, don't waste the moment we're in right now, because I'm doing some things in the last 2 years and over the next 2 or 3 years that will permanently alter the trajectory of my business forever. And there's no reason you guys can't do the same. So any thoughts, any questions on this?
Tyson, I really like what you said about US versus international. I had the same philosophy myself. And about 80 to 90% of the Betterment clients that I'm moving over, there's no questions asked. We're just moving the money over. Some people want to sit down in the office and go over things a little more in detail. But one of the things that I've been pointing out that makes this move superior for them is that Betterment requires you to have at least 30% in international on any one of your or percentages. So I'm like, we now have the freedom to go a lot higher into the US, which I can't guarantee future performance. But if you look back over the last any period of time, you're looking at, we should have higher performance by making this move with the exact same risk tolerance.
You got it. I that's words right out of Matt. That's exactly what I say about Betterment. I'm like, I have no
Yep.
ability to alter this portfolio, to customize this, to actually manage it for you. And that's why we
Yep.
got to move it to a platform where I can add a lot more value.
Yep. Yep.
Well done. All right, Logan, can you go ahead and kind of recite a recapture of everything I just talked about and your understanding of all this? That'd be great for the group.
Actually, this has been one of my favorite trainings. I really am into this kind of stuff, and that
Yeah.
the models are really interesting to me.
Hey guys, I
Um,
I I take a lot of pride in being simple. Just because something is simple doesn't mean it's not sophisticated, and just because something is complicated doesn't mean it is sophisticated. There's great power in simple stories, simple things, and don't try to outsmart. I mean, I sometimes I'll tell clients this. I'll show my models when I'm explaining FMAX. I'll be like, hey, there's a lot of window dressing, and that's a phrase I use. There's a lot of window dressing and marketing in our industry. I mean, I could add some, go back just to give you guys set your eyeballs on it. I could go in here and go to research, all solutions, and we could go into mutual funds here. And I mean, pick your poison. I can add 2 or 3 of these funds. we could get into, dynamic value, commodity, there's gold and silver, there's all kinds of stuff in here. I could do a lot of window dressing, add 2% of this and 5% of that, and I could come up with this really complicated looking model. But ultimately, I don't think that adds value over time, unless there's a meaningful role to have that in the portfolio. And you guys, why I'm such a believer in owning core indexes is because it's a self-updating portfolio. Okay. We've got our Jackson wholesaler next door. He's going to give us a presentation. But as when I'm using Jackson, it's the same thing. I'm using core index funds because if I own the S&P 500 index, the weakest bottom 10, 20 companies are going to constantly be rolled out of that index because growing companies are going to move into that index because their cap weight gets bigger. SpaceX is going to do an IPO. That's a whole other conversation that we don't need to get super detailed on, but it's kind of an unprecedented event on many levels in the stock market history. But it's going to be added to the S&P and the NASDAQ within like 15 calendar days, which is a special deal that when you're the richest man in the world, you have a little bit more leverage than anybody else because that's never happened in the history of the country. But you're going to own SpaceX whether you like it or not. And so the point is, like, when I own index funds, I have a super efficient, benchmark index. It's going to outperform active managers 98% of the time. And for every, 1 or 2% of funds that actually outperform the S&P over 10 years, good luck picking that horse 10 years prior and riding it the whole time and realizing that outperformance. That Oakmark fund I showed you, it might, without looking at it, it might be on the short list of funds that over 10 years beats the S&P 500. It might, but you're also going to have years of massively underperforming the index to offset the years where you overperform. And so our value isn't stock picking. Our value is identifying clear trends that are irrefutable in our economy, which we've covered today. And then I want to leverage my clients. I want to hitch them to the wagon of the engine that's growing the fastest, which is US growth. And yes, there's going to be times when emerging markets pop, and there's going to be times when gold goes crazy, and there's going to be times when everybody panics about growth stocks. That happened in January. A couple of you guys were kind of asking me, I think Joe and Alec were back in Joe's office earlier this year, like, man, what's going on with this large cap growth index? It's not doing so well. And it wasn't. But you're going to have those periods of underperformance. But I'm not skating all over the ice rink wherever the puck is. Over time, those funds are going to do the best. And anyway, and that's what you have the ability to do on FMAX, as well as, guess what? Well, what are we doing with RILAs? We're literally tracking indexes with some volatility control. That's why I love RILAs. We're able to lock in those gains and reset those buffers. And I'm doing the same thing in my BUL. I'm just picking index funds because, there's a big misnomer in our company. A lot of people ask me, like, well, if I'm just doing some index funds, how do I justify my fees? And I'm like, because most people aren't going to do that on their own. They're not going to properly allocate themselves. They're not going to do all the proper account structures, fund Roths, fund SEPs, do all the stuff we do. So there's a lot more to that. We could do a whole training on just justifying your value. But again, that's really core. So I hope this has added some value to you guys. Any other thoughts or questions as we're wrapping up? All right, you guys. Well, that's all I had covered. Alec, anything on your end?
No, I don't think so. Ryan's gonna cover training next week, so yeah, let's keep getting some business going. I plan on implementing a lot of this into some of my conversations